Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Good to have you with us. Of course, so much going on globally and on a macro level. Let's get straight into it now. And joining us is John Blank from Zacks Research. John, very good to catch up with you. Thanks for joining us. Of course, dominating markets at the moment, those geopolitical risks we're seeing out of the Middle East, but there's so much more as well to consider, particularly in the States with the CPI read, earnings season upon us. What's your take on how investors should negotiate the landscape at the moment?
Yeah, Andrew, I was doing some work last week and I came across a really interesting set of data called the weekly economic indicators. WEI, I had never heard of this. This was on the Federal Reserve of St. Louis website, and it's a 10-factor weekly indicator. And what's interesting about it is it is showing that we've been in an expansion this entire year, and we're 2% higher on GDP than a year ago, according to this indicator. So one of the main things that's not being communicated well, and we need to do it right now, is this year has seen an expansion in the underlying growth. And what's interesting about this, since it's weekly, it runs through the end of September, which is through the third quarter. And as we're going into this week, later this week, particularly the next week, we're going to get third quarter earnings and revenue numbers that are basically drawing upon this basic insight that nobody wants to believe, but that weekly indicators indicate, which is it has been an expansion all summer. So we're going to get a lot more beats and a lot more optimism than people think. That's what I would bet on.
All right, but also a focus clearly, as I said, what's going on in the Middle East at the moment and how that is affecting energy prices right now. We're seeing those oil prices continue to increase. That essentially becomes a tax on the economy. How concerned are you about those energy prices and where they could go?
Well, first of all, as a function of the S&P 500 energy the index, is not a very large part. It's 2, 3, 4%, and depending on how you want to count it across all the other sectors. And it's also very volatile, Andrew. So generally speaking, the Fed will not care much about the energy movement, and the stock market won't price in much of it. It'll be basically something that will be playing out over a time scale that almost no one can control. So at the end of the day, with uncertainty, it's always in play, but there's so many other things that play a bigger role. For example, the U.S. election is probably, in my mind, a bigger role than this. And a lot of these other uncertainties are going to have to be baked in as well. So it's, again, the problem with all these things, they jump at us, but then we forget that we're in a multi-factor world with lots of uncertainty, and the interest rate uncertainty still dominates, and that's still playing out.
Yeah, absolutely. Well, John, every time you join us, you come to us with some great ideas. Let's get into them then. You've got 3 stocks to take a look at. The first one being VMware, computer software. What are you seeing here?
Yeah, VMware, ticker VMW. And the reason we want to talk about this stock, and we're going to talk about Dell today too, is they closed their deal to spin off from Dell in the fourth quarter of 2022. So now we're at the third quarter of 2023. And you can see ever since that deal got closed in 2022, this stock has been a tear. It went up from $100 to $160. We've got a target price at $190. And you've got $7 a share in earnings this year, $8 next year. So what do these guys do? This is cloud backbone stuff. So it doesn't matter whether it's Amazon, Google, all these different major groups, they're providing some type of server type virtualization for all those groups. So you got to like this stock because it's in the right space. The traders like it. It's got the fundamental support, and it's in tech stocks. And basically tech stocks are not going to be that influenced by the stuff that's happening in geopolitics.
All right. Well, we've got a common theme just looking at the computing industry at the moment. The next one being Synopsis, once again software. What it actually designs, it sells electronic design automation. Talk us through this one.
Yeah, Synopsis, Andrew, we got to make sure that people understand what they design here. They design the actual way to make a chip. So this is actually in the framework of sending in software to chip makers. So this is a chip. It effectively is a back-end chip stock. Ticker SNPS. It is very hard, Andrew, as we put this chart up, to find a more attractive stock. I mean, look at this. It moves up from $100 a share to $460 over the last 5 years. It's got super smooth annual estimate revisions year on year. $10, $11 this year, 12.5 next year. That's a nice growth pattern. You've got a 40 some PE ratio. It's definitely a growth stock. I mean, VMware's got a 24 PE ratio. They've got a 43. So everything is screaming at you to stay with Synopsis because it's going to keep growing. So of the three we're going to talk about today, you got to like this one the most.
Okay, that's your favourite one. Thirdly, to Dell Technologies, widely used, particularly as far as hardware is concerned, but beyond that, in fact, I'm using their technology right now. What are you liking about Dell?
Well, Dell, first of all, as a stock, it's an A-rated value stock, and I've got a 10.5 PE ratio. If you're a value buyer, you got to like Dell. So why do we care to talk about Dell, Andrew? Obviously, we all know this company is the PC, some broad PC supplier of choice out there, because their estimate revisions are going up. So if the slump is over in PC laptop volume after 2 years, which is what the estimate revisions are telling us, if they are getting a bid and the stock is reflecting that bid already, which means there's some material interest in that story, in believing it, then you got to like Dell. And again, what's interesting here is Dell picked up the parent of VMware, EMC, in this whole deal. So the other thing is Dell has acquired some of the server cloud infrastructure, enterprise infrastructure from that VMware company, and they rolled it into this Dell. So the other thing we need to understand here is the Dell we're talking about, Andrew, is not the Dell you and I know from 15, 20 years ago.
John, 3 stocks to consider right there. Great to get your view as usual. Thanks for joining us from Zacks Research.
Yep, thanks, Andrew.
All right, now let's switch to China. And data out of the Tiger economy over the Golden Week holidays pointed to a continued uneven recovery. For her take on how to trade, Zelina Zeng, joining us from Credit Sites. Zelina, good to catch up with you again. Thanks for joining us. So we did have a raft of data out over that week. When you talk about an uneven recovery, what are you looking at?
So I think the overall data still showed quite healthy recovery of the Chinese consumption and overall economic data if you compare it with 2022 when the economy was still in deep lockdown. But if you look at the numbers comparing to pre-COVID levels, which is in 2019, there is still some weakness here and there. Overall, the consumption is about 10 to 15% higher compared to 2022, but is still below 2019 level for many different aspects, such as the box office, traffic flows on railways, highways, as well as the waterways and domestic passenger flow has not been as strong as the 2019 levels. So I think the set of data still showed continued recovery within the economy, but I would not say it's very inspiring, especially many data points were below the authorities' official forecast before the Golden Week holiday.
All right, so given the spending you're seeing there, perhaps what the consumer is doing, how would you trade that, just in terms of, I guess, particularly e-commerce and the like? What's your view?
So we still like the e-commerce platforms because if you look at the consumption data for e-commerce retail, such as Internet of Things, home appliances, and as well as some of the consumer electronics, the consumption is still quite strong on online retail China channel, and this is going to benefit a lot of the e-commerce giants such as Alibaba and JD, and we continue to like Chinese tech dollar bonds. On the other hand, if you look at the property consumption data, over the Golden Week holiday, the recovery is still very uneven in the first-tier cities where the support measures are targeted towards. And the recovery is pronounced, especially in Shanghai and Guangzhou. But if you look at the tier 2 and other lower-tier cities, we still see home buyer sentiment being very weak. So overall, we still don't like the Chinese property dollar bonds, and we are still very cautious towards the property recovery in the Chinese economy.
But of course, as we know, it's hard to avoid what's going on in the property sector in China, given how it looms over the broader economy, and you only have to look at the issues at play, particularly some of those property giants such as Evergrande. How do you see that playing out?
Yeah, so I think the foreign media has caught a lot of headlines regarding the debt restructuring or the store debt restructuring of China Evergrande Group, as well as the potential offshore dollar bond restructuring of Country Garden. Both are both are the largest Chinese developers in China. But overall, we think the negative spillover effect into the other dollar bond sector should still be quite limited at the moment, because first the size of the China property bond outstanding in both the onshore and offshore market is quite limited, and I think it's less than 5% of the overall Chinese bond outstanding. And secondly, the government is still prioritizing the home delivery, which to some extent is a comfort for a lot of the home buyers as their homes are still being delivered. So I think the systematic risk so far is still contained within the economy. If you look at the bank's balance sheet and the capital adequacy, this has substantially improved over the past decade, and the government has taken some preemptive measures to replenish the capital of small and medium-sized banks. So yeah, I think the property sector is going to continue to be a multi-year drag for the Chinese economy, but at least for now, the systematic risk is largely contained.
Okay, you say it's contained, so that contagion risk then you say as is limited beyond property.
Yes, correct. At least for now, I think a lot of the foreign medias are also focusing on the local government debt, especially because of the large proportion of the government revenues are coming from land sales. However, we think the funding condition for this segment has actually significantly improved over the past 12 months. In the onshore bond market, the local government financing vehicles, the spread has significantly tightened over the past few months, especially for the weak ones, just because the central and local government's willingness to support has been very high. The banks are also providing quite a lot of liquidity support to these weak local government financing vehicles. And I think in the medium to long term, this is definitely still an issue for the Chinese economy, as in what is the final resolution for the local government financing vehicle. I don't think the government has a very clear answer for now. Basically, they're kicking the can down the road and buy some time. But for now, over the short term, I see the systematic risk coming from the property sector as relatively contained.
Zelina, in terms of the corporate bond sector then, what are you finding attractive?
So in the Chinese dollar bond space, honestly, I think the pricing has been very expensive. It's a quite interesting phenomenon, actually. Despite the dollar bond default of the Chinese property developers, investment-grade Chinese dollar bond has tightened significantly over the past 12 months because of the limited new supply coming in the Asia dollar bond space. So investors are flying to quality, aggressively chasing a lot of the higher-rated Chinese dollar bond. So China Tech has tightened quite a bit, and as well as some of the short-dated state-owned enterprises dollar bond. So I think in terms of spread tightening is probably going to be quite limited over the next 6 months. But for investors looking for high quality and short-dated safe carry, we still like China Tech dollar bonds. We also like some selected SOE space. I think for the broader Asia dollar bond space, we think the value coming from the Korean SOEs is better than the Chinese SOEs because of the spread pickup.
Zelina, thanks so much for joining us from Credit Sites. And that is the global view on this Tuesday. Just before we go, a check of where we're likely to get going. Looking to be positive with SPI futures. They're up more than 0.4%. Stay with us. The Open, just around the corner.